Welcome to Dig Deep, the mining podcast. In this podcast, we go deep into mining news, hot topics, and live interviews with mining professionals and leading figures in the mining industry. Introducing your host, Rob Tyson, founder and director of Mining International and Mining International Executive, a leading global mining recruitment and headhunting agency.
Hi, mining community. Welcome back to another episode of the Dig Deep, the mining podcast, the show that brings you the latest insights, thought leadership, and stories from across the global mining industry. In today's episode, we have Rob Crayfourd and Keith Watson, co-fund managers for CQS Natural Resources Growth and Income and Geiger Counter Funds and Golden Prospect Precious Metals. Both funds which provide shareholders with the exposure to a broad portfolio of mining and resources-focused equities aimed to deliver both steady dividend income and growth capital. We discussed the uranium market and the investment case behind it. We're also going to talk about the funds and their mandates and where they're currently seeing opportunities across the sector and what's been driving the recent momentum in the actual uranium price. We're also going to explore whether the momentum is sustainable and the fundamentals supporting uranium long term, and how a potential supply deficit could shape global nuclear ambitions. And finally, we're going to look at policy and regulatory shifts and the thinking behind some of their key portfolio holdings, and obviously a lot more. So that's welcome both Keith and Rob to the podcast. How are you both doing?
Very well, thank you, Rob. Thanks for having us on.
Yeah, very well. Thank you. And yeah, thanks to everyone who's listening in.
No worries. As we always start these podcasts off, and obviously you guys were on probably a few years ago now. So for those that didn't listen to your previous episode, appreciate if you can go back and have a listen. But for those that may not know you, I wonder if you can just tell us a little bit about your backgrounds, a little bit about your career, and how you got into the mining industry and what you do within the mining industry. So I'll hand it both over to you.
I'm Keith, and my background is, at least in terms of education, in physics. That was my degree. Been looking at the resources sector for a number of decades now. I've been running the 3 closed-end trusts that you referred to earlier, Rob, alongside Rob for over 10 years now, nearly 12. And we look at everything, all of the commodities around the world. In this specific podcast, we're discussing primarily the uranium sector, which is the focus of the Geiger Counter Trust. As I said, it's closed-end. But my background is ultimately a little bit more technical. So by degree, I'm more engineering bent. I've looked at the uranium sector for a long, long time. Also been on the sell side looking at these, and I'll hand over to Rob.
Yeah, I'm Rob Crayfourd. So I've kind of been doing this for over 20 years on the buy side. Studied geology at university, so kind of certainly took some of that education into this. Done CFA, but I'd say sort of main thing has really been learned kind of on the job over the last 20 plus years of meeting hundreds of different management teams, seeing different projects, kind of understanding where the pitfalls are and where the risks lie in kind of executing on assets. And yeah, I guess it's that background probably has more value than my geology degree from all those days ago, but it certainly gives me a good filter on sort of speaking to management teams and being able to call them out on certain aspects, which is certainly a useful factor.
Yeah. I wonder if you can just give us an overview of the fund and its mandate.
I'll continue there because I nearly got sidetracked onto that subject. Yes, just to quickly reiterate, this one is a closed-end trust. It's probably one of the longest-standing uranium-focused or nuclear industry-focused trusts that we've been able to dig up. And as I said, Rob and I have been managing this for over a decade now, actually through a fairly tough market. When we look at this trust, and I think all of our trusts, one of the key advantages is in being closed-end, we're not forced sellers of things, we're not liquidity constrained, and for that reason, we tend to focus on certain aspects of investments that others are unable to because of those liquidity constraints. So typically, we would focus on valuation over a pure liquidity constraint. and that's a very advantageous aspect for this trust and all of our trusts. What we look for, and I'm sure we'll touch on this more when we go through some of the industry background that I'm sure lots of the viewers will be well versed in, is those companies that can, for this particular sector, deliver the new pounds that will be required over the coming decades to deliver baseload power. And I think that's one aspect that we would be very keen to get across as a unique point of this sector and this trust, is that nuclear power is now very strategic, in that there is a clear shortage of baseload capacity in most regions around the world, and nuclear is a very important part of that energy mix in fulfilling that strategically short baseload capacity. And we've seen a huge swing in sentiment both from the government sector and I think the general public in a wider energy context for this industry in particular. We're allowed to take focused positions. Actually, this is probably one of the most concentrated markets that there is out there. And I think if I were to try and illustrate the differentiation of this trust versus some of the ETFs that people no doubt are aware of, it's that we're not looking at the likes of the richer valuations that are applied to the most liquid names such as Cameco, but instead looking at some of those projects which will deliver new projects of similar scale to those owned by Cameco, and one of those would be the likes of NextGen. And I think that's one key differentiator. We're not heavy Cameco, we're heavy NextGen in comparison, because we feel there's a better valuation there. There's more exposure to the upside of the commodity price, which we're still very bullish on, even though we've had a good move in it. And we've got other aspects in the portfolio alongside that. But in essence, I think that is one key point to highlight in terms of the portfolio positioning. We're not trying to be me too. We've very much been invested through the long term in NextGen, and that's the type of style that Rob and I typically follow across all three trusts. We like to get management teams that we can back and that have delivered previously.
I guess one thing I'd just have add as well, Keith kind of framed it very well around Geiger Counter, but in running the other, the three trusts in total, so we've got Sequest Natural Resources, which is sort of far broader, and kind of across energy and mining. And then we've got Golden Prospect, which is precious metal focused. But in having the three trusts, it actually gives us a much more balanced view of kind of the relative valuations versus other commodities. And actually within Sequest Natural Resources, we've currently got around a 13-14% weighting towards uranium miners, which versus the underlying MSCI World Metals and Mining or MSCI World Energy is clearly a huge relative overweight. And I think that's quite illustrative in showing our conviction towards this as a trade, as a theme, and we're kind of very constructive on the outlook, given a number of the fundamental drivers, which I believe we'll touch on.
Where do you see opportunities within the uranium sector? Obviously, looking at various things like geology, phases of development, etc.
Can I jump in? If I kind of refer to kind of our positioning here, so within the Geiger Counter Trust, if you look to the breakdown of how we're positioned, we've basically got very large overweight towards North American assets, and that's very much intentional. And also overweight towards developers, given our very large weighting towards NextGen, and again very intentional. And the key reason for that is that because we're so very bullish on the outlook for where the uranium price is heading, we want to be in those names that firstly are at the most attractive valuations, but also have full participation into a rising price environment. And we believe that those names are far better placed to do so, not least because the valuations are more discounted, but also by being weighted to those sort of developers like NextGen or the likes of Denison. They aren't contracted, so they don't have fixed price contracts set out for the next 5 years for a significant portion of their production. And as a result, if the uranium price goes to 150, 200, 250, then they get full participation in that. And that's something that we certainly want to be reflected. But another major factor within that allocation is if we look to the global reactor fleet and where inventories lie, we kind of view the West, and then you've got the East, which is primarily China, and then we look to inventory. So China has a much more material inventory for its reactor fleet, which is growing into as it's adding 10 reactors per year, and thus needs a higher inventory. But then we look to the West, and they've got much lower inventories, and we believe there is a real structural shortage, a sort of deficit situation becoming increasingly evident for Western reactors, and we want to be in those names that are best positioned for the Western reactor recontracting cycle that we see coming up. And we've started to see at the early stages, but ultimately those North American producers, and that's heavily weighted towards the Athabasca Basin, which is basically a geological freak in that it just runs much higher grades than we see elsewhere. So geologically super interesting, but also in a tier one jurisdiction that is preferential to Western reactors that are looking to diversify, prior reliance on Russian material as they move forward.
And Keith?
I think Rob's answered most of it there, to be honest. I think we look at, I would come back to trying to get the best management teams to develop assets in the tier one regions that Rob has outlined. We actually see some of the better valuations in those entities anyway. So that's primarily the reason for the fulcrum being on those type of assets when we talk to the overall positioning. If there was one other aspect, I would say that we know we must remember, I'm sure lots of the listeners will be aware of this, that in Western markets, the established nuclear markets, nuclear represents something like 20% of electricity capacity. And put in context, the uranium, the raw U3O8 that goes into fuel that every year is only something like a day and a half to 2 days worth of oil trade. And that makes it, we think, all the more strategic, a pinch point in a commodity that actually China doesn't really possess in its own domestic market to the extent that it is required to for its build-out program. And that's arguably a mirror situation in the West, but more so because they've really left this industry out on its own, hung it out to dry, post-Fukushima in particular, where we've had a 10-year bear market, involved in sort of ESG policy that no one was really wanting to discuss this because it was a bit of a political hot potato. What crystallized this, and I think quite usefully referring back to Rob's earlier comment in us managing and looking at all the commodities, particularly in the energy sector, was the energy crisis post-COVID and post the Russia move on Ukraine. That really prompted, I think, the sea change in attitudes, both from the government's perspective and I think from consumers, to actually openly discuss this. And it suddenly became very apparent the wonky policy that had effectively frozen this industry out and resulted in underinvestment and the shortage of supply, which takes time to address. And one of the points I think you raised earlier is stage of development. When we look at the portfolio construction as we have it, one of the most advanced in terms of taking a 10-year permitting program is the likes of NextGen and the likes of Denison that represent, top positions in this trust. That's a crucial aspect.
There was obviously momentum in the uranium spot price at the start of the year. What would you say drove this?
Is it all right if I step in there, Rob?
Yeah.
I think what we see is, again, refers back to the point that Rob just touched on, is overall industry inventory levels by region in particular. And I think we see the sort of activity levels of purchasing by the ultimate consumer, which is the utility company that puts these through the reactors, coming in bursts. But one of the key aspects to place this in context is that if we looked at inventory, some of the latest data, which to be fair is a little bit out of date, but if we jogged back a couple of years as the price was spiking first above $100, what we saw was Western inventories of raw, and I'll put this in U3O8 equivalent, raw U3O8 inventory was trading down at something like 2 years. It might have even snuck in slightly lower than that. That's typically the low end of what we would consider a sensible inventory level, because it takes 2 years to mine uranium, convert it, enrich it, manufacture fuel bundles, and get it into reactors. You're at risk of disruption if you reduce your inventory level to below that. Then we had a few little hiccups come along, some geopolitics that may have just raised the risk on that. And suddenly the whole industry went to restock because it had wound down to those sort of critical levels. And then we had some shortage of all of them, what we call upflex their contracting by, say, 15%, which allows them to pull forward some of their uranium that they'd contracted to a greater degree. Suddenly the producers likes of Cameco that had already sold forward most of their production had to scramble around to get extra material to deliver into that flexed demand. And they had to go into the market and purchase it. And we saw the price spike up above $100 a pound. Now we've had that got them to a more comfortable level of inventory. This last 12 months, certainly running into Q4 last year, that was used. And again, we were back down at this kind of 2-year level, we think, of inventory. And then lo and behold, in Q4, we get a little bit more activity coming back into the market. Alongside maybe some requirement by some of the big producers, again, those that had locked up a lot of their production forwards to come in just for small quantities of material. And lo and behold, we're back at near, at least briefly, $100 again. Overlaying all of that, of course, we've had the incumbent physically backed ETFs also being allowed to front run some of this potential for activity. So, the Sprott Physical Trust has sequestered material. It's now up to something like 76 million pounds at my last look of material. They have been able to raise money with their at the money facility and basically also compete with the utilities for that inventory. And I think in combination, that's all lifted the price run that we've seen. Again, at what level will how will utilities behave from here? I still think there is good reason to think that they need to seriously consider the levels of working capital that they have. But the very fact is we're still, bumping up and down around those minimum levels year in, year out. And we go through the seeming bursts of utility activity. But we think that, there needs to be much more longer term contracting to deliver on these aspirational targets that we've talked about since COP28, COP29 in the West, to at least triple the baseload generation from nuclear capacity. Frankly, a lot of fanfare has been made around 10 reactors being built in the US with, the AP Westinghouse designs. China's doing that every year. By the end of this decade, it will overtake in the US as the largest installed nuclear market. And, for that reason, when we compare their inventories, as Rob outlined, they're running at something like 8 years worth. But they see, looking down the pipe, that they will need that, not only for their domestic rollout, but perhaps for wider One Belt, One Road policies as they deploy their cookie cutter designs that they have developed for much more rapid deployment elsewhere around the world. So they're looking for cradle to grave supply chain, right from mining, processing, and delivering reactors, because they want the full value capture, both domestically and, I think, to increase their footprint and influence on the energy markets globally.
I might just jump in. I mean, so some of the most recent drivers, and especially around sentiment, has been the focus on nuclear as a major source of the energy solution for AI data centers. So we're obviously seeing the huge amounts of capital, 700-800 billion projected to be spent next year or this year from the big hyperscalers, and ultimately it's becoming evidently clear that the ultimate bottleneck in all of this is going to be energy supply. So what was thought to be a bottleneck around chips became a bottleneck around sort of data centers, but ultimately that all falls back to power, and that becomes the key gating item. And I say that because the other aspects you can kind of throw money at and find a solution for. You can build more fab units and build more chips, but ultimately trying to adjust power networks and power solutions is a much longer lead time. And this is something that I think is going to become increasingly evident. We certainly believe it's a strong theme over the next decade. We believe that certainly for Geiger Counter, and we're certainly reflecting that within TQS Natural Resources as well. And you kind of look at the different solutions as you kind of go through. So we've had the big headlines out of the US of closed reactors restarting. We're seeing reactor lives being extended, and there's a real kind of shift to a much more positive political support backdrop for nuclear. We're seeing more restarts in Japan. etc. And as Keith was saying, whilst that gets a lot of headlines, it all kind of pales into insignificance versus the 10 reactors per year that China's adding. But I think this kind of real focus on geopolitics, given US actions sort of globally, and the kind of reshoring trends that we've broadly seen, and then this kind of battle around trying to be the winner within AI and data centers really brings it back to energy as being kind of a key focus. And with these reactor life extensions, I think that's kind of started to bring the utility buyers, and this remains kind of one of the biggest questions in the uranium market is when you look at the fundamentals. And I appreciate this is going to be a long answer if I try and go through all of those, but it's just been increasingly getting tighter and tighter and tighter over the last 4 or 5 years. And we can kind of touch on some of those more fundamental factors, but we see a very clear projection, or we have very clear data on what the demand number is, because we know how many reactors are out there. We know what their usage is. You run a reactor at full capacity or kind of 90% utilization, because the bulk of the cost is ultimately the capital. So the variable aspect doesn't really matter. So the demand side, we have quite clear visibility on, shifted slightly in the kind of reactor life extensions, but really it comes down to this kind of constant supply shocks we've seen, whether it's Russia, Ukraine, whether it's sort of coup in Mali that's lost supply into Europe, and the market's been getting increasingly tighter. But what's encouraging for us is that we've finally seen utility buyers taking notice of that. And there's a number of factors we can kind of talk to. I'm aware I'll kind of run too long if I try and address these individually, but it just feels like they're sort of waking up to this kind of structural shortage, and it seems to be led by a couple of utilities, primarily in the US, that are a bit more kind of on the ball with this. And and Keith talked to that kind of average stockpile that we have, which is a WNA, World Nuclear Association number that we end up getting provided. That's an average. And I think within that, some of those US utilities will have higher inventories and some will be left shorter and a bit behind the curve. And this is when you really start to see inflection points in price moving, because, as we discussed there, uranium fuel is such a tiny input to the overall cost at around sort of 6-7%, that even if it doubles, triples, quadruples, you don't ultimately use less. They may back off from contracting or term contracting. We've seen that in previous kind of price spikes. But the reality is the ultimate usage remains. And if you're running low inventories, then you just don't have a buffer there. And that's certainly something that we're anticipating as we go forward, without even kind of factoring in any of this talk around sort of SMRs, et cetera, that come at the later in the decade. But if we see those kind of feed through as well, then that could be a real incremental source of demand.
And I guess following on, is this momentum set to continue? And also, I suppose, what fundamentals actually make uranium compelling in the longer term?
I'll jump in there. I would say that we will get little bursts of activity. Maybe we're in the midst of one now, but ultimately, I think absolutely the momentum has to continue, and I think that arises because of the point that you raised latterly there, Rob, which is that ultimately, even assuming these most advanced in a permitting sense, greenfield projects come on stream, that the brownfield restarts also come on stream, we're looking at data that consistently says the market remains in deficit. Now that means there has to be a price to incentivize yet more supply. But more than that, come the turn of the decade, and this assumes perfect execution on these most advanced projects and brownfield restarts. More than that, given the growth in demand that we're looking at, even tempering that somewhat, we need multiples of these new mines to come on stream over the next decade. And, we've got to find those, first of all. That's going to take time and money. And in the meantime, the higher cost marginal assets have an incentive price that will be considerably higher than here, we expect, in order to deliver the pounds that will be necessary to not act as a bottleneck as well to these aspirational growth targets. So yes, I think it's right to take not just a short-term view on this, but a longer-term view. This is typically a long-term cycle, and frankly, it's only just started with the energy crisis that was caused post-COVID. we could have a decade in this.
If I can add a bit to that as well. I mean, we're seeing particularly in the US, we're seeing policy really focused on a pro-nuclear stance. Material amounts of money are being thrown at trying to address fuel supply chain. Remembering it's 20% of US power. They're trying to build out data centers. They really need this stable baseload power to remain as a minimum to sustain those. Otherwise, they just fall behind China in this kind of AI race. But where we're seeing money being allocated, so they've committed to building 10 new reactors, which again that'll be over a number of years. Put that in the perspective of China's 10 per year. But they're also throwing money at conversion and enrichment. The one thing they're not throwing money at is the mining side, and it's our belief that we believe it's fact. These are much longer lead times to try and bring on. So, if you're adding conversion and adding enrichment, but you don't have the ultimate feed supply in, you can't just bring on a mine in 2 years because you've thrown more money at it. It has to go through an extensive permitting process. And we've seen this very evidently with the likes of NextGen that's taken over 10 years to get to this stage where it's now within a month or two of probably getting its final permit. And you just can't accelerate that. You can't, NIMBYism will remain highly focused on anything with kind of uranium and nuclear in the title. They can't accelerate or push through environmental studies and community studies beyond that. So it just leads a long lead time. So that just leaves you heavily reliant on global supplies. So other than those projects that are coming on in the Athabasca Basin with NextGen and Denison, which are factored into those numbers and still leave us as a deficit over the next projected decade, and this is WNA numbers, not our own. That means you're just heavily reliant on supply from Russia. So I mean, Russia's only 6% of primary supply, but they have JVs in Kazakhstan, but they also have around 40-50% of enrichment, with the next biggest component of enrichment being the Chinese. So in this world where we've got kind of reshoring, protection around the supply chain, they're just basically heavily reliant on Russia and China, with Kazakhstan being the largest supplier of prime, U3O8, and Kazakhstan's positioned with the largest land borders with Russia and China, with its main export routes being through Russia and China. So it's basically this real sort of geopolitical situation where you've got this kind of reshoring, but you've got the biggest source of baseload within the US and across Europe is heavily reliant on potentially a kind of unstable geopolitical supply chain, and they're trying to reshore it, but it really just kind of shows a gaping lack of pure U3O8 supply. We look to Cameco, who openly state that they're pretty much fully contracted out for the next 5 years, and then you kind of look to where else you're getting new incremental supply from. And so, other than these kind of new projects in the Athabasca Basin, there's very limited kind of sources of new supply. So yeah, look, it's what does that mean? Where can prices go? I mean, we're talking here just about a supply-demand balance, and which is kind of openly in deficit. If we actually get into a scenario where utilities, who now should have far more confidence that they can kind of extend their reactor lives, given the much more friendly bipartisan political support. So this isn't just a sort of purely Republican, or even in Europe, we saw with Germany closing its reactors and openly now stating what a mistake that was. The political shift has really, really shifted more supportive. So we're seeing reactor life extension and more talk about new reactors being built. But ultimately, there is not enough focus being made on where this raw uranium is going to be coming from, and we think that's a real bottleneck. And as we said, there's a tiny component of costs that if you get into a restocking cycle, this looks even more extreme, and it can really lead to a shifting by multiples, not just percentages.
As you've obviously alluded to, there is a looming supply deficit. Will this come to fruition, or what will it really mean for the nuclear ambitions of states?
Well, and if can I just jump? I mean, just to finish on the final thing as well, and then this comes into that. Keith talked earlier about total uranium sales annually being less than 2 days oil sales, and that puts in perspective if it's a really low dollar value where we're in this world where China dominates large proportions of overall processing, there's just complete logic there for China to continue to buy as much material as it can from the Kazakhs or from the Russians that are in excess material and build up their inventories. Because not only does that backstop their own energy supply, it also backstops them building reactors elsewhere globally, which is dollar-wise a much bigger component and far more lucrative for them than the tiny uranium mining sector relative. So yeah, I think that's certainly a key driver of stockpiling.
I think we've kind of addressed it in that we're in that situation now, and I think what surprises us is the complacency that the uranium buyers and the utilities seem to have. And maybe that's a function of their heavily regulated status. It comes back to the point that Rob raised in that demand really doesn't change with price, because the uranium, even when we add on the conversion enrichment as elements to the overall fuel cost of a bundle, is far less significant for a high fixed cost reactor than it is for pretty much any other form of fossil fuel power for baseload. Where if you double the price, you'll probably nearly do the same on the underlying electricity price overall. And ultimately, there aren't. We're looking around. Where are the next projects coming from? We've got to find them ultimately. And I think the US has the ability to buy more domestic material. And one aspect of the portfolio construction that I didn't discuss earlier is that one of the other big exposures that we have is to arguably slightly higher cost than the tier one assets that I have been referenced, but is the old producing assets that still exist in the US. But they're fairly small compared to the overall US consumption rates. But we think that it would make sense for them to try and support that to a greater degree than they have done lately. But ultimately, yes, we're in a deficit market. I think what people have struggled with and maybe been slightly surprised by is the efficiency that these new physically backed ETF structures have, that enable them to effectively get in there first. If you have to go through committee to get approval to buy something, sometimes you find you're at the back of the queue and you've missed the opportunity. And I think that is a function of some of the utilities, not all, but some of them. So things have to smarten up. But ultimately, I think there's a good reason to say that there's a greater requirement for working capital in the supply chain in pretty much every industry at the moment because of the way government policies are working. And uranium is probably one of the most extreme that hasn't yet reacted to the degree we would feel would be prudent. And, yes, we'll be remaining in a deficit market until that price gets to a level and the projects get to a permitted stage where that can be addressed. And I think that takes a lot of time.
Obviously, policy and regulatory changes are likely to impact future supply and demand dynamics. I just wondered if you can comment on that.
Well, I'll come back to my earlier comment. I'd say the demand side is pretty much known, because if you build a reactor, you keep running it. There is the demand growth aspect, but I think with this kind of reshoring world we're seeing and focus on energy security, I think that only adds more weight to continuing to build out reactors. So yeah, I think that remains pretty clear. The supply side really is where you kind of get all the uncertainty. So we talked to it earlier of some jurisdictions are more tricky. We had the coup in Mali, which ultimately led to the loss of supply into Europe for that material, particularly into the likes of Rivik in France, for example. So yeah, they're basically having to try and offset that loss of material as well, which has effectively left them short. So yeah, we're talking here to where we have a balance, but there is the potential for mining issues. We look back when Cameco had its flood at Cigar Lake. You could potentially have another mining shock. You've got mines in difficult jurisdictions. It wasn't that long ago that we've seen kind of protests in Kazakhstan that ultimately saw the Russian military come in and kind of quell those protests. But it just shows that you've got a producer that's larger component than OPEC in oil, that the world is so reliant on, yet Western utilities seem happy to run on low inventories. It seems completely insane to us, and we've spent spent the last couple of decades trying to get full clarity of kind of why they aren't seeing the same. Well, certainly last decade, seeing the same issues we're seeing. And yeah, look, I think there's a lot of chat around, post Fukushima that that was a kind of driver of why the uranium price was weak. The reality is we went through that kind of weak, almost decade in uranium price, but the primary driver there really was the complete growth in supply out of Kazakhstan as they found kind of new reserves. We've transitioned to where we are today, and what we're seeing, and again, you kind of have to pick through the data, but it's clear that they're bringing on projects that aren't nearly as low cost as their earliest projects, and that's just natural. You kind of pick the lowest hanging fruit first, and you're not seeing the same level of growth out of them. And in fact, actually, they've kind of downgraded growth projections as they had acid shortages. And that's kind of had impacts there. And then even the big producers like Cameco have kind of downgraded some of their production estimates out of the likes of them big MacArthur River mine. So it's showing that uranium mining is hard. It's often in difficult jurisdictions. There's potential for disruptions. There's potential for geological issues that end up kind of taking knocks to growth or production expectations. And even under what we would view as a pretty much perfect outcome by the WNA, which assumes that even projects that aren't permitted all come online on time, which almost never happen. I mean, almost never happens in mining in general, but in uranium mining, it's almost more. It's almost less likely. But they kind of presume this kind of perfect execution and no disruptions, and still point to a sustained deficit for the next decade. And the WNA data is ultimately backed and financed by the utilities, so isn't kind of being produced to try and argue a case for the miners. If anything, it would probably have a bias more in the other direction, and still doesn't even paint a kind of balanced environment. So yeah, I think that's where we're at. We're kind of very, very constructive on where it heads. But it's different from other commodities. It's not a sort of just-in-time commodity because you have these 2 years inventories. It's not like oil where you can only hold sort of 3 or 4 days, inventory within a country, and you kind of consume it. So you end up getting greater volatility. This is much more a big oil tanker. We believe it's a decade-long theme. There will be sub-cycles in it, depending on where sentiment's at, but ultimately, I think sentiment is increasingly turning more positive as people kind of look forward to those fundamentals as we shift on. And ultimately, if we get uranium price moving materially higher from here, then the stocks start to look very attractively valued.
Could I just add on one point that wraps in both sentiment and I think regulation? One aspect that we think has perhaps had an over influence on sentiment was I would call it mutual import restrictions imposed by the US on Russian material and the retaliatory export bans that Russia had imposed to the US, which is more material in its impact. Now, I think, people look at the potential for a Russia-Ukraine ceasefire deal being reached and how that means that there's a pacified sort of relationship between those two, the US and Russian, and that therefore there's an increase in the availability of Russian material. I think we should all remember that actually trade has been continuing to take place under agreed waivers and licenses, in particular for exports, still to the US, that have been granted by Russia. That's now out till the end of 2027. Notwithstanding that, though, I think there is already in place a desire by Western utilities to, as much as possible, reduce their exposure to that region's or reliance on that region, because actually they don't want to be exposed to it. But the fact is that seems to have ignored the fundamental shortage that there is, that if it doesn't go to the US, it still finds its way out into the market, probably to China, probably at a discount to China, which gives China a little bit more leverage in the overall cost equation of developing nuclear power as it happens. But I just really want to say that, I think some of the volatility in the equities that we see around that issue that overly impacts sentiment is something to acknowledge but not be scared about. for us, I think it prevents buying opportunities when people panic because they think there's this wall of Russian material that's coming back. To a degree, for a period of time, yes, I get that. But unfortunately, that material is needed and it will be consumed. And in the meantime, I think the Western utilities will have to find that from somewhere else. And it's a temporary factor.
Yeah, and I'll add to that and reiterate that the point we're making earlier is uranium should be very much viewed as one of these strategic metals, much like rare earths or other commodities. And it's certainly our belief that the likes of China will view it as a strategic metal that they can exert some degree of political influence over. So this, logically, there's a clear incentive for them to buy any excess Russian material they can, or continue to hold stockpiles, because that lessens the interference that ultimately US policy can have over them, because they can kind of restrict that supply over a material portion of Western energy supply. So I think it should be included in that kind of strategic metals, because it's hugely strategic. If anything, far more significant than some of the more minor metals in its overall impact. And I think sometimes that gets lost versus some of the sort of more niche metals that get referred to.
If we can discuss your top 5 holdings, obviously the reasons as to why you've chosen those companies, and your identification process and maybe selection process that you go through.
Sure. I'll kick off, and I think just revisit the point that I made earlier, in that by being closed end, we're able to look at some of the companies that are at a different stage, either of the development cycle and the valuation cycle, and the liquidity requirements that other funds might have imposed upon them. And the standout position for us is that, unlike the ETFs, which have, call it 20% of Cameco, we're slightly more than that. And actually, if we included, the OPEC of the market, the Kazakhs, you'd be looking at something like 30%-ish of those ETFs invested in those two. We would take something between 20 and 30% as our position in the likes of NextGen, the most advanced development project, which trades at a much better, more attractive valuation than either of those two, but especially the likes of the go-to Cameco, which has already not really got that sensitivity to the uranium price that you would like, and where we see actually the most operating leverage. And for that reason, that is one of our biggest positions. We have historically taken positions with management teams that we think are good at discovering ore bodies, and I would say that you have to be fairly lucky or extremely skillful in order to find these things. We were involved in NextGen right at the very beginning, and that's below 50 cents. I think, I can't remember the actual first list price, and we've followed our money all the way through the raises where we've been able to. I know there have been recent questions around the ore body and its ability to deliver as described on the tin with regards to the regulated 43-101 that they have developed, but we're comfortable with the geology, with the resource as it's stated. They've put over 500 holes into this. They've done the spatial statistical variance on it, and yes, they're looking to do conventional mining on it, which is actually probably potentially lower risk than some of the less conventional techniques that are used in some of the wet rock deposits in other areas of the uranium-rich Athabasca Basin. And ultimately, that forms the fulcrum of where we are in a Tier 1 district, one that already is familiar with uranium mining, with a management team that you can't really argue is at least aligned in terms of something like 95% of its pay structure being, share rewards rather than base salary and the likes. Some things will inevitably be argued about it, but that one is a Tier 1 asset and is being set up for its strategic value that it actually represents, and we think deserves a higher valuation, at least equivalent to something that you might find on the likes of Cameco, which could be, a double of the share price from here. When we look at elsewhere, one of the next biggest positions that you would be able to reference off our monthly fact sheets is a much smaller operator that's based in the US. Again, back to that earlier comment that I made, I won't reiterate why. It's a previous producer. It's restarted production now. I think costs are slightly higher. It's probably slightly slower. And I think that is a fact that we just have to accept in this sector, that ultimately, brownfield restarts are also subject to some cost overruns that we see. But remember that limits the number of pounds available for utility buyers, and that therefore there is a compensation in some respects with regards to the longer term fuel price that they might receive as a result of that, if they're not overly contracted. We've got the likes of Paladin, again, similar issue on its underlying Langer Heinrich project, being out there to see it. Namibia is still one of those stable governments in Africa that we quite like in terms of the fiscals that they have, not deviated from. There's always a bit of a risk at that when prices go higher in any commodity, frankly. Latterly, they have bought out one of our, again, earlier projects that we owned pretty much from the get-go, which was the Fission asset, neighbouring NextGen, which we actually felt would have been a much neater fold into shared facilities that will be developed by the likes of NextGen. But, they weren't in a rush to do anything with it, NextGen, and Paladin fancied taking it out. So that was a slightly larger than we liked position. We actually therefore reduced it somewhat, but it's still in our top 5 at the moment. Having had a few issues with regards to the startup of that operation, I think with grade control on some of its stockpiles, in part alongside some of the water aspects that come with Namibia, it's still got some upside, but it's probably one of the richer valuations because it's, again, at the head of the queue. We've still got some Cameco to a lesser degree than we had. And sorry to run through this, I hope you can bear with me. We owned less of this prior to its purchase of the actually quite strategically canny move to acquire the 49% in Westinghouse from Brookfield. But, when we see the valuation move, I'll fall back on the fact that, we have to pick out where we see the best risk reward. And, that one has been, screening out because its valuation is now one of the richest in the sector. And we've got another one, Energy Fuels, which can produce both uranium through its already licensed and permitted facilities, alongside some aspects of rare earth, which have some of the stronger sentiment swings that we see in the sector, and again is US based.
And then sort of in the top, sometimes moving in and out of the top 5. So then we've got the likes of Denison, which we touched on earlier, also in the Athabasca Basin. Then you've got ISO Energy, which we think is a really interesting one. Actually, big ownership there from NextGen, as it previously had spun out of NextGen. But they have the highest grade deposit globally in the Hurricane deposit, also in the Athabasca Basin. But they also have Coles Hill, which is the largest undeveloped uranium asset in the US. So, just given this backdrop that we're talking to of tight supply, we just think a project that's been moribund for a couple of decades ultimately could see a improving political environment and support towards permitting. So it kind of shows that kind of North American tilt. Paladin obviously has the Namibian asset. We think that's kind of interesting that you can kind of sell to the West or to China, which kind of creates some strategic tension. But then, with that kind of heavy weighting towards the Athabasca Basin, just because geologically, those deposits stack up really well versus anything else we see globally.
And lastly, just wondered if you can just give us an overview of the uranium market, where you see this moving in the short to medium term, and anything else that you want to share with our audience.
If I may step in, Rob, I would just summarise that we still see, to greater or lesser extent, substantial deficits in this market, which are partially addressed, but only partially addressed by perfect execution of some of the greenfield startups that we've discussed, around which I think we get probably an overly sensitive sentiment run based on, what will or won't happen with regards to US-Russian sentiment on their relationship and the ability to tap Russian supplies going forward. But again, all in context of the deficit. We've been through the positioning and why we think our closed-end trust is allocated the way it is in terms of the tiering of assets and the regional exposures to the assets that we have. One factor I do think is worth remembering, particularly now, is that come the end of April, shareholders, for every 5 shares they own, will get the right to purchase one new one at 37.2 pence. There'll be a cut-off date for that, somewhat announced sometime probably in early mid-April. And that's just, a method that we've tried to implement in order to grow the assets because actually we go through periods a little bit like now, frustratingly, despite our overall bullishness of the market, where it trades at a discount, and that can make vanilla equity issues for the UK listed investment trust market a little bit more difficult. But here, the strike price was set last year when there was a bit of that sentiment fallout, referring back to the Russia-US situation, and you're well in the money on that. And I think that is something I would entirely encourage everyone to really pay heed to, and make sure their platforms are sufficiently funded to ensure they get their embedded rights. And finally, where does the uranium price go? I don't think much can stop it, frankly, until it could easily be in the 150s plus, 150s to 200s before other aspects that feed back in this fuel supply act to dampen that sort of price movement.
I just had a quick comment just on sentiment. I think, as we go over the next 12 months, I think it's going to become more general knowledge that energy is a real kind of bottleneck towards this build out. So we've seen the huge amounts of capital being thrown at data centers, as we were talking to earlier, but it doesn't seem to be widely understood by the sort of big generalist funds or the broader market that energy is ultimately the big gating factor. So we see comments of people suggesting gas can be the solution. Even now we look at the big turbines from the likes of GE Vernova. They're about a 6 to 7 year lead time now if you want to order one today. So that means gas is going to be difficult. Existing grid infrastructure just is insufficient. Most capacity that has been added has been through renewables, so is too variable to kind of meet any of the needs for these data centers. Equally, nuclear takes time. So that's why the first moves have been about extending reactor lives of ones that are projected to close, or restarting ones, because that can be done quicker. But nuclear is going to be an important part of that solution going forward. But I think when you kind of get this big, AI has been the biggest theme in the market over the last few years. If you start to get these question marks around energy being the bottleneck, that'll put more rivals onto it. And given the tiny size of this sector relative to the huge size of the overall big tech sector, that even a tiny rotation into kind of covering that can have a huge impact on underlying valuations. And that's certainly something that we think could be very possible this year, as we see that story kind of build out and become better understood from broader generalists.
Great. Rob and Keith, really appreciate your time. Thank you for obviously sharing your story and obviously giving us a detailed account of the uranium market for now, and looking into the future, and obviously speaking about your Geiger Counter funds and some of the companies that you're investing in and obviously following. If our audience wants to reach out to you, and obviously we'll have questions and obviously follow the story, how can they go about doing that, and what social media platform channels you're on?
In the first instance, I would direct them to the NCIM website, which will show all of the trusts that we manage, and they can find the tab that takes them to the Geiger Trust. I think on there you will also see links to some of our former presentations, webcasts, our monthlies, the general fact sheet data and accounts, and interim and full year commentary and outlook statements that we provide. I'd say that's the first port of call. On there you will also see that there's an NCIM contact email address, and feel free to drop a line via that.
Yeah, great. And we'll include those in the show notes for obviously easy access. So thank you guys for your time, and watch this space. And I think uranium will be slowly coming back into the headlines, and obviously in relation to obviously energy, which is obviously a major topic at the moment and for the foreseeable future. So thank you guys for coming on and sharing your insights.
Pleasure. Thanks for having us, Rob.
Thank you.
Nice. Thank you. Thank you for listening. Hope you enjoyed that episode. Obviously, a lot of detail to unpack there, looking at obviously the uranium space. So obviously it is a topic, and especially energy is a topic in the news at the moment and will be for the foreseeable future. So really appreciate if you can share this episode far and wide, share it with people obviously within our industry, but also people outside of our industry, because obviously energy is needed by everyone. And it's good to really understand the different forms of energy that is available and will become available in the future. So thank you again for listening, and until next time, Happy mining.
Thank you for listening. Remember to reach out to Rob via the show notes and be sure to subscribe and leave a review. Until next time, happy mining, helping each other to improve the mining industry.